Big estimates beat, huge capex, and negative free cash flow. And if you look closely, that huge profit explosion is actually driven by a nearly $98 billion accounting mirage.
Yeah, and the market absolutely noticed.
It's July 22, 2026, and you're listening to Earnings Unscripted. We're digging into Alphabet's second quarter, ticker GOOG, and honestly, the tape looks a bit grim. The stock climbed mid-quarter, but just gapped down hard in the extended session. Miro, they cleared almost $120 billion in revenue, up nicely year over year, so what caused the panic?
It's really the earnings per share, Susie. The headline numbers look absurd. They printed $9.11 a share.
Right, and Wall Street only expected roughly $2.88. That's a massive surprise.
Exactly, except it isn't from selling more ads or cloud subscriptions. The bulk of that beat comes from an unrealized gain parked down in their other income line.
Okay, wait, back up. Unrealized. You mean their stock portfolio just went up and they fed that straight into their net income?
Yeah, basically. It's paper wealth from their equity securities. So retail investors see that bottom line jump and assume the core business just magically quadrupled its margins. It didn't.
Before we unpack their valuation any further, I should just clarify that we're simply trading opinions here, not giving anyone personalized investment advice. But Miro, even ignoring the paper gains, didn't they actually have a stellar operational quarter? Like, YouTube literally hosted an unprecedented wave of World Cup viewers. People are streaming matches directly to their living rooms.
The underlying demand is definitely healthy, sure. But the penalty for staying relevant in the AI race is getting violently expensive. They blew almost $45 billion in capital expenditures in 3 months alone.
Wow. So a company historically known as a total cash machine actually burned cash this quarter.
Right. Their non-GAAP free cash flow swung completely negative. They're throwing servers, data centers, and networking gear at this AI problem so fast that their operating cash flow can't cover it anymore. They actually went out and issued equity and debt to fund operations.
A fortress balance sheet going to the debt markets to buy servers. That's genuinely wild, and it totally explains the after-hour sell-off. The part that actually confused me in their report, though, is how they're generating some of that cloud growth. You told me earlier they're quietly becoming an AI hardware dealer. Tell me exactly how a software cloud business starts selling physical tech directly to customers.
It sounds completely contradictory, right? Google Cloud was historically all about selling virtual space and software. But on the call, the CFO specifically noted they, quote, started delivering TPU systems to customer data centers. They're physically boxing up their proprietary AI hardware and installing it on site for clients.
Wait, let me make sure I've got this. They're just selling generic server racks to companies like Dell or HP? Like some standard wholesale electronics deal?
No, not quite. They're not becoming a white label manufacturer. They're taking their Tensor processing units, their crown jewel custom silicon, and dropping entire closed systems directly into massive enterprise clients' facilities. So it's essentially this hardcore, dedicated hardware lock-in, but they're blending it into the cloud growth segment.
Ah, okay. So it's not a software subscription at all. It's a massive, chunky hardware installation.
Right.
But doesn't that totally warp the economics? Hardware's notoriously low margin compared to just spinning up virtual servers.
That's exactly the issue. And when an analyst point blank asked management to break out the TPU margins on the call, they completely refused.
Of course they did.
Right? If you're hiding the margin profile of your newest revenue driver, it's almost always because it doesn't look as pretty as the core business. It temporarily supercharges that cloud revenue growth, but you're trading high-margin software dollars for capital-intensive silicon sales.
Well, clients must be eating it up regardless. You showed me that contract backlog earlier, and it was just astronomical.
Yeah, the total backlog ballooned to over $514 billion. That's a massive leap in just 3 months.
$500 billion in locked-in contracts? That's wild.
True, but here's where the wheels get wobbly. They're selling these physical systems to lock in customers, right? But internal AI demand's so overwhelming, they actually don't have enough infrastructure to run their own workloads. They can't build data centers fast enough.
So they're cannibalizing their own compute just to fulfill these client hardware deals.
Worse, they're renting from the neighbors. The CFO admitted it on the call. She said, quote, "Given the supply-constrained environment, we plan to expand the use of third-party capacity in Q3 as a bridging strategy. However, it will create modest margin pressure in the near term."
Wait, hold on. Google's buying cloud space from someone else because they ran out of servers? That's like Starbucks having to send a barista to Dunkin' because they ran out of coffee beans?
It's extremely ironic, but it shows you how intense the physical bottleneck actually is. And when you combine that third-party rental cost with the headaches of integrating the recent Wiz acquisition, it means cloud's bottom line will take punches from multiple sides going into late 2026.
It really makes you wonder if the absolute kings of global data infrastructure are maxing out their physical limits and renting capacity from outsiders. How is anyone else supposed to survive the sheer capital cost of this AI race?
They don't. That's the cold reality of this cycle. The moat isn't just clever software anymore, it's brute force capital. If Alphabet has to stretch its balance sheet to keep up, smaller players will just get entirely squeezed out of the foundational AI layer.
It's kind of a brutal consolidation when you frame it like that. And honestly, it doesn't sound like they plan on taking their foot off the gas anytime soon.
Not a chance. Management's totally doubling down. They updated their full-year capex guidance to somewhere between $195 and $205 billion. That's a staggering escalation from their prior targets.
Wow. You know, earlier we talked about that massive paper gain inflating their bottom line. That feels like a bit of a ticking clock, right? If the equity markets wobble next quarter, retail investors might misinterpret a non-cash drawdown as the sky falling.
Exactly. That's the real risk heading into the back half of the year. The core operations will probably keep grinding out solid demand, but the headline volatility is going to be wild.
It just feels like a completely different business now, less of a nimble search engine and more of a heavy industrial utility grid.
Yeah, it's a pure infrastructure play today. And infrastructure requires patience and very deep pockets. Let's just hope the market has enough of both.
Okay, given the after-hours tape, patience might already be running thin. All right, we've probably picked enough of this quarter's numbers apart. We'll be watching to see how those hardware margins shake out in the fall.
Always a pleasure. Got you later.
If you've liked hanging out today, maybe just tap follow in your podcast app so we pop up the next time you need an earnings fix. Just a quick reminder that this entire show's an AI experiment, meaning we're completely synthetic voices, and that's exactly how we process all those dense Alphabet filings to get this episode into your feed the very same day the call happens. We'd love to hear what ticker you want us to tackle next. So shoot us a note at earningsunscripted@datamadness.ca.
Talk to you next time.